This is TABcast, brought to you by the Alternative Board,
helping business leaders improve their business for a better life. Hello all, and welcome to episode 11 of TABcast, brought to you by the Alternative Board. Thank you to all of you that have listened in over to the past 10 episodes. Episode 11 today is all about exit and planning for exit. Now, you might be listening thinking, well, I'm not ready to exit, but hopefully today's guests are going to give you plenty of insight into what you need to do in order to plan for a successful exit. As you know by now, this is not about us. This is about some wonderful guests around the sofa. And today we have three wonderful guests who are going to share their expertise and indeed their experience of exiting businesses. Simon, give us a quick introduction, please.
Hi, my name's Simon Brayshaw. I co-own a business called Dexterity Partners, and we specialise in preparation, sale of the businesses to an exit for an owner, whatever that exit may be, management buyout, trade sale, whatever.
Excellent. Preparation, I'm sure that's a word we'll come back to a lot today. Ben, a few words, please.
Yeah, my name's Ben Hirst. I am a portfolio non-exec director, so I'm helping small business owners navigate their way through to success, whatever success may look like for them. But prior to that, I'm an exited founder. I set up a company called Horizon Platforms back in 2008 and exited that business via employee ownership, or an EOT. And again, prior to that, I was a minority shareholder of a company called Uplift Platforms, and we exited that business to trade, but private equity backed. So, in view of today's topic, I'm hoping I can add a couple of different views on the subject of
I'm sure you can. Preparation, exit, success, EOTs, all terms that we're going to delve into a little bit. The one word we haven't talked about yet is people, and that leads me nicely on to Rena. Rena, tell us a little bit about why you're here.
Sure, thanks Liam. So my name's Rena. I run the Elevated Limited, which is a leadership development company, and we really think about the people in an exit. So today I'm focused on how you can get more of the asset of people, how you can develop them, and actually once the owner leaves and exits the business, you're left with something that can carry on and make lots of money for the new owner.
Great stuff. So there you go. You can see that today is going to be a very successful podcast because we have three very experienced individuals who have done it and help people do exactly what they want to achieve. Let's start with the end in mind, if we don't mind. Give us some reasons around to why people do want to sell and some of the pitfalls that might fall out of not being a successful sale. Simon, why does exits fail?
Exits fail because of preparation. Many owners leave it too late, and there's suddenly an illness, shareholder dispute, divorce, retirement, COVID, all those factors, and they've left it to the last minute. And really the saying of, fail to plan, plan to fail is never truer than in the case of an exit. You need to look early because some of the things that improve the chance of a sale, and only 15% of smaller businesses actually sell, which is a really low statistic, because they haven't done that preparation, which may be a year or two in advance. You've got to have a mentor, a team, a non-executive, a TAB member. Those make a big difference to having a plan.
So 15% of small businesses fail to sell when they're ready.
Yes.
I heard a line not so long ago of about, doesn't matter when you're thinking about selling, that preparation actually should be starting now.
Yeah.
Give us some insight into what business owners should be doing now.
Right. Just before, only 15% sell, 85% fail to sell, just so we're clear.
Yeah.
But some of that preparation, I think, looking at the people side is critical. Most owners have done it because they've been entrepreneurial, they've been driven, and then they're departing. You've got to look at it from a buyer's perspective. If the key person is leaving, the star, would you buy that business? Your star striker's disappeared in football terms. And would you buy that business? So it's building a team around you in advance that almost can operate, not without you, but with very much a light touch from yourself.
Excellent. Thank you for that. Ben, you've been there, you've done it, you've gone through that preparation that Simon's talked about. What did you learn from that whole process, particularly around that preparation of getting ready for exit?
Yeah. So, so I'm with Simon. I think number one, succession. Regardless of how you think you can sell your business, what route you're going to choose to sell your business, whether that's to trade, private equity, MBO, or employee ownership, succession is critical. Selling to trade, succession is critical. Sam hinted it there. If you want to create value, you've got to demonstrate that the business is actually an investment. It will run without its star striker. Thinking about MBO, well, that's obvious. You're looking to sell your business to the managers that are coming through the ranks and developing within your organisation. But having had the experience of selling to an EOT, transitioning the business to employee ownership, be interested to take Simon's take on this. But the minute you sell your business, you do feel slightly differently about it, and I did. I felt from the point the business was no longer mine, it was right for me to start thinking about creating room for others to develop and to appoint the next leader of Horizon Platforms. And so I think that is, as ever, best dealt with over a longer period of time. The challenge, though, and I'm sure many small business owners will feel this, is being an MD, being the CEO, being the boss of the company, certainly when times are good, is a fabulous job. So somebody's turning up and saying, no, you need to start stepping back a bit. If you want to sell this a very long way down the line, you really need to start thinking now about handing some of this stuff you really enjoy doing to somebody else. So that's difficult.
Can I ask you why you decided employee ownership trust was the right way forward for Horizon?
Sure. So my business partner and I, the co-owner in Horizon Platforms, we'd worked together in the previous business. And as I mentioned earlier, that organisation was sold to trade, private equity backed. That exit was a clash of cultures. The business we owned and ran was incredibly customer focused, great team engagement. I'd like to say wonderful culture. The incoming private equity national buyer was different. It was very, very profit focused. They'd got debt to service and often with private equity, your thinking was quite short term. And so answering your question, we didn't particularly enjoy the process. Yes, we successfully sold the business, but the culture, the brand, everything we'd worked so hard to create pretty much disappeared overnight. And so yeah, we were still carrying those scars. So when we started to think about how to sell Horizon Platforms, we remembered that experience well, and we were keen to choose a different route. And building a similar culture within Horizon, when we were introduced to the concept of selling to the employees indirectly, it felt like a good fit, and hence we pursued it.
Already, a few minutes in, we've recurred this word of culture and what culture means. And let's be clear, I think culture is around your people, how they feel, how they act, etc. What does culture look like within an organisation?
Well, I'm just thinking back to one of the things you said at the point of leaving, and you have to allow them to do the job. And we talked a little bit about this in the cafe before, like that creation of who will run the business without you needs to happen way sooner. And you have to create something even before you want to exit and leave, so that you can exit from the day to day and still be around. So you can be there to mentor people into the next role. For me, that's the important bit about thinking about your people around exit. It's not about when the deal is done. It's the bit leading up to it. From the first moment when you think about, I may want to sell this business in 5 years or 3 years, and sometimes 6 months when they come to you in a crisis. What are they going to do to take that time to build the asset of the people, so that when you leave, you have, confidence that the business will carry on? Nobody wants to sell something and it fall apart. I don't think, most of the time anyway. So it's about building the culture way earlier than you think, from day one.
Let's just pick up a little bit of that. How do you go about building a culture? Thoughts?
Well, so really interesting point you raised there, because my belief, and to your question, Liam, is the leader builds the culture. The leader influences the culture. It's the behaviours that we display every day within the business that impact how things get done around the place. Mm-hmm. And that's my definition for culture, how things are done around the place. Mm-hmm. So an interesting reflection that I carry on exits is, and especially back to this succession thing, is, I've set cultures in organisations as their leader. I can bring in a successor, and they can be highly competent, highly successful, and move the business on through its next chapter. But the culture will be different. The culture will reflect how they are as a person. And so I think it's interesting to think about what advantages there would be for any business owner making that transition, succeeding themselves prior to the transaction, so that culture can develop risk-free almost, because the business hasn't been sold. Because it will be different to the culture within the organisation that they founded. That's my belief, anyway.
So, if culture is led from the leader, how do businesses ensure that culture set out by a leader is aligned throughout the team? You've said there things have changed. Thoughts on alignment? How do you get your people aligned to the culture that the leader's trying to set, Rena?
Well, there's a 3-step plan. It's as easy as that. It's not that easy. You sort of talked a little bit about like living it day to day. And I think that's the most important thing. I don't think the owner is responsible for the culture. Everybody in the organization is responsible. So I'm a big fan of, if you see something that's not going right, call it out. You need to have trust within an organization. You need to build accountability, and not in a challenging, horrible way, but in a way that says, this is not how we do things. This, we buy into this culture. We've got the right people, and it's obvious when you've got somebody who's a mismatch. If you've got a really strong culture and you bring somebody in and it's wrong, it's obvious, and you have to take, evasive action. Coaching, mentoring, something along those lines.
If I could just jump over to yours and Ben's point there about the 3 areas of that culture. One, coming back to private equity, it's choosing your right private equity partner, because it's the culture. Often in private equity, there's an earn out, or it's not a full 100% sale, so you're going to have to adapt. Both of you are going to adapt. So there's at the top level, how do you bring 2 strong personalities usually? Owners usually are top dogs. So the first time somebody's questioning them is a big cultural challenge to them. I think, Rena, on your point about it is within the organisation, because when you're looking for the exit, the biggest risk is, and especially in some professional services or people businesses, it's not bricks and mortar, is that people culture's got to stay, and it's got to be embedded as within everybody being involved in it before, so it stays after the owner
and continues to deliver.
And
they
absolutely,
don't just stick around,
because otherwise they'll leave. They'll frankly leave and go somewhere else, and then you've bought a pup. And that's really, really key. So there's the culture of the buyer with the owner for a period of time, but that will eventually disappear. There's the culture that's got to stay. It's got to be in everybody. That's actually there, and it's how you migrate those through. And it is about ownership from the bottom up. And just asking a very simple question is, do you know what do you know, strategy gets a bit sort of overused and sort of technical, but do you know what the plan is? Do you know where the business is going? What's the vision? What's the values? If the person, I don't want to say at the bottom, but in an organisational chart at the bottom, if they understand what's going on, you've got a pretty damn good culture, and you've got a pretty damn good chance of success. And that future success, we call it fit for the future, is what people will buy. The buyer's looking, they don't care about the past. I'm going to spend £1 buying your business. First question is, will I get that £1 back? Never mind, will I make £1? Will I get the £1 back? And if the culture's wrong, they're not going to get it back.
So fit for success, planning for the future. Why is it 85% of business sales fall through?
Because they don't have They don't have the management team, that senior leadership team, the group at the top that's still going to there. It's too owner dependent. That's actually, they don't have a clear business model. So everybody knowing what they're doing, simple things like how I price, how the relationship with customers. It can't all be the phone call back to the owner.
Yeah.
You know, if that's there, that's why, and that's picked up really easy. Everything's done what academics would call as it's tacit rather than documented knowledge. It's in the owner's head.
Yeah.
Document that and have that plan. And the final thing is, this is what's so important about starting early, of what the non-execs, especially what TAB are doing. Measure and monitor. Start, and you've got milestones. We delivered that. It's what owners don't realise and buyers completely ignore or don't value is, oh, you could do this. They give you get lots of opinions and options and things.
Yeah.
I want the facts. I want the evidence. And the evidence is, we've had a plan for 2 or 3 years. You know, we've been working with that. We started here, we did this.
Yeah.
Oh yeah, I can see I've got a pathway to what we're doing. And the numbers then support it.
Yeah.
Which is the final thing. You know, it's again, well, we outsource our accounts and we just look at them and we manage the cash. Owners, that's okay because you're in the business. A buyer, they want to see how those numbers relate to those actions. Get the numbers right.
Quick question for you. How did your role change 2 years prior to your exit? And if it didn't, tell us why it didn't.
So we sold the business to the OT in 2021.
Yeah.
And I exited mid 23.
Yeah.
So the summer of 23, I stepped into a sabbatical.
Yeah.
So and that was with the intention of jumping back in 6 months later.
Yeah.
So that was the final kind of test for the succession plan that I'd been working on. But on the run up to that sabbatical, to answer your question, I was actively doing less and less in the business to the point where I genuinely was not involved in
You made yourself redundant.
any of the day-to-day whatsoever.
How easy was that for you?
Well, we talk about developing great teams. I've been very, very lucky to have attracted some amazing people to the business throughout the time I ran the company. And part and parcel of what motivates me is to see great people develop themselves within a good organisation and actually achieve things beyond where they expected they would be. And so we've always invested heavily in our people. And so that started to pay dividends when I was looking to hand all of my role into the senior team for them to take charge of. So in terms of capability within the organisation, day-to-day management, they did brilliantly, and I'm super proud of them for taking that on. For me personally, it felt very strange. It was difficult. You know, I enjoy being in the detail. You know, I enjoy looking at the numbers and ensuring that I've got a good handle on what's happening in the business, every area of it. So yeah, it was a conscious discipline to be, you know, asking questions at a much higher level than I would have been when I was actively running the company.
In your experience, guys, how easy do you find that business owners are willing to follow in Ben's path and do less as they get closer to exit and allow their staff to step up?
Quite difficult, but what Ben's just described is really a good acid test for anybody thinking of exiting their business. Because one of the questions we ask, especially on some of the smaller businesses, why don't you do a management buyout, an EOT? Why don't you do that? The team are, they're not capable. So,
and who's to blame
I'm
for
a buyer.
Yeah.
You've just sent the big red flag here.
Yeah.
That's what a buyer's going to conclude as well.
Yeah.
That's absolutely fundamental, and it doesn't happen overnight. You'll either be if there isn't those people in the organisation, then God forbid you get run over by a bus, the business is going to collapse anyway. You're not. Where's your insurance policy? Even if you're not going to sell, you know, where's the? I keep calling the senior leadership, the core group. And if you don't think they could do a management buyout, I'm not saying they have to do it, but if they're not capable of stepping up, then you're going to struggle selling your business anyway.
I think as well, one of the things you talked about there, and it sort of goes to your point, is you want to develop people. You've bought them with a certain level. You don't want them to stop at that level once they get into your business. You want them to keep developing and coming with fresh ideas and being innovative. So your role as a leader is to create that environment where they can step up, where there's space for that. So sometimes that means, taking a step back from something that you enjoy. Sometimes, not all the time, that would be boring. And letting somebody else take over and try it out while you're there to support them and eventually see them do it for themselves. I imagine it's like children taking their first steps or something.
Yeah.
And
for me, regardless, that's creating as a leader, creating an environment where people are able to grow.
Yeah.
Is part of the role of any leader.
Makes your business stronger as well. It
absolutely
gives you
extra.
Yeah.
But in terms of testing that succession, ultimately testing that succession, my reflection is take as long as you can possibly afford to do that. So get yourself away from the coalface, properly away from the coalface, ideally for years, not just months, because you got to bear in mind, there's an economic cycle, and if you get yourself away for 6 months when times are good, then that's not really putting the team to the test.
But we get to meet plenty of business owners, and we ask them, when was the last time you had a 2-week holiday with your family?
I was just thinking that, yeah.
And they say, well, I don't, because things will fall apart. So what advice can we give to business leaders who buy into exactly what you're saying about, yes, I want to do a little bit more. Yes, I want to give greater responsibility into this, but this is my baby. This is mine. How do you begin to do less within your business and still allow that structured continued growth?
How does it work? Jump in onto that, that's something that's really key, and I think there is a solution to that, and it's what Ben have suggested, is that it may be operations, it may be finance, it may be sales, whatever it is, new business development. Pick up those areas and go with an individual. And so you're not saying, I'm walking away from the business completely. And this is why it takes time, and without sort of pushing tab too much, this is what you do quite rightly force people to do. You're saying, right, okay, let's talk about running the warehouse that you get involved in, or winning new business.
Yeah.
Pass that on to ABC, him or her, to see how it goes. You're always in the back. If it works, you leave that to go. Mm-hmm. That's gone. And you're almost ticking off key parts of the business to think, I've got a leader, an owner, not so much a leader, an owner of that part of the business. And that's the acid test to say it's running without you. Because, as I say, we're back to the thing, if you can't take a 2-week holiday, you're not going to sell it. Which is why 85% don't sell, because it stands out a mile. It's like, it's not rocket science to identify as a buyer.
Yeah.
No, this won't run without you. You can't sell it.
I agree entirely with what Simon said there, and I'll pick up on something you said earlier, and around the power of writing stuff down.
Yeah.
Because you're very often, and I've been guilty of this in the early days, you will set your expectations of your team verbally. And I think we probably all know how effective just verbal communication is, especially if it's over the telephone. It's pretty ineffective. I think it's like 20-25% is actually absorbed. So the power of actually writing down your expectations of an individual in their role, and being explicit with what good looks like, and add some measures in there that will get properly tracked, is, in my experience, quite remarkable. Because if you do that for all your leaders in the business, and you ensure there are no gaps, not too many overlaps, then there shouldn't be a reason, assuming that you've had the conversation around, look, this is what I expect of you. Do you feel capable to do this? Mm-hmm. If not, what areas can I help you with? Yeah. Is it training? Is it development? Is it you're more resource within your team for you to delegate more? But if all areas of the business are covered by what you've written down in terms of roles and responsibilities, then there's no reason why you can't take that 2-week holiday, because you've properly delegated the running of the business to your team. But so often it doesn't get properly written down and then those expectations properly measured.
Very quickly, that piece of paper, don't put it in your drawer.
No.
Stick it on the wall. Tell the person if they're in their area of their office or the building, wherever they are, stick it on the wall. Say, let's just take that bit of blue tack off the wall. Let's just talk about it again. How do you think you're going? That's the measurement of really those, and they're not often quantitative. It might be qualitative issues of how many people have you met, whatever it may be.
Yeah.
It's using it so they're clear of what their objective is, and they know it's important because you keep asking them and say, how do you think you're progressing?
Can I just play a point of, I'm now an employee in a business, and my business leader has given me these roles and responsibilities, and we've changed culture. I want to ask that business leader, why? Why are we doing this? My question leads into, when should that business leader put their cards on the table and think, I'm leaving in 2 years, 3 years? It might be a management buyout. It might be an EOT. It might be a trade sale. I sense some business owners are reluctant to do full disclosure to their employees for fear of them worrying, of leaving, etc. Thoughts, advice on when should a business leader begin being very open with their employees? Thoughts?
I mean, I'll just jump in quickly. You said the word fear, and for me, that's what it is. And the conversations about leaving aren't about, I want to leave now. The conversation should be about empowering and being able to walk away from the business for holidays. That's how you get people comfortable with it, because you've set it up. They know that they don't have to contact you on the weekend. They're empowered. The fear is gone. And even if you're going to leave the business, they've got it. They feel comfortable. So for me, that fear word is what's holding people back from saying, I'm going to leave the business in 5 years. Like, why not tell people in 5 years? What opportunities does that present for you if you're my leadership team and you know that I want to leave this business in 5 years?
And I think you're 100% on the money there, Rena, in the sense of, it's not about, I'm going to sell and run.
Yeah.
It's the business has got to be sustainable. I've worked a long time often, which they have, many years into that business. I want this business to be sustainable. We've grown, we've got to a stage. It can't be about me. I'm giving it its empowerment.
Yeah.
Not resolved to walk away and disappear, after that area. To answer your question directly is, I think mentioning the word exit, I'm going to sell, it's a scary factor for people who want to be comfortable and safe, and they've got their mortgage and families to look after. I better go, I don't know what's going to happen. It's sustainability to maintain what we've got and develop. And hopefully, as an employee, as a colleague, that gives you greater empowerment and greater influence in the business. That's what we're doing.
So let's just go on, man.
Yeah, I'll just come in on this if I can. So,
your show.
So the reason my business partner and I wanted to create a liquidity event within Horizon Platforms was simply to de-risk our personal situation.
What is a liquidity event?
Well, some form of
Cash.
Some form of cash, yeah, yeah. So whether it's a debt raise or you're selling some equity, so to take cash, material amount of cash out of the business. Yeah. We'd grown a business to 20 million turnover, 80 employees, that kind of scale. So a business of material value, and compare that value to what we carried personally, it was out of kilter. So for the good of our families, we needed to try and just right that slight wrong. But we loved the business and wanted to be part of the business for years to come. So our event ideally would have seen us take some chips off the table, but not all chips off the table. So when we agreed, we were looking for some kind of part sale. We weren't looking to exit. We were looking to just take de-risk. We shared that with our senior leadership team. And we explained why, which again, authenticity, a big key part of leadership. They understood, because we were being completely honest with what we feared, not being able to predict the future. We needed to just protect our family's future based upon the commitments that we'd taken on. But we said, look, we're not sure how we're going to do this, but we want you to enjoy some of the spoils. So we hope within the next couple of years there will be a moment where we'll realise some cash for the value we've all created in this business, and we want you to have some of that. And so we wrote up what we call a long-term incentive plan, so that we were all focused on creating value for this event, and that for me, I'm not sure would have been able to get to the point of an event without sharing it, because I think we were talking earlier about just how demanding the sale of a business is on the leader's time, 6 to 3 months out. You can't just suddenly disappear for 3 to 6 months to spend time with accountants and lawyers. So to be able to share this journey as soon as possible, and rightfully share some of the spoils of the ultimate goal with your senior team is right. Now, sharing it with the wider team, I just think it is risky, and I don't think it's worth the risk. I don't think people would appreciate you knowing.
Jumping on that last point, you're right. I don't want to call it the circle of trust, is it? Meet the fuckers or whatever. You're in the circle of trust. Is because exit just can scare customers and suppliers and the stakeholders in general, the banks, everybody who you're in with. So I think, being frank, yes, you do decide who you bring into the circle of information, especially if it's not an EOT or a management buyout, because there is that area. So it does tend to be later. And we often do see is that the wider team doesn't know till very, very close to the end, because they're scared about everybody knowing. They're stressed about the deal. That's why we do the end-to-end. Everything from start to finish is us we managing, because you're juggling a lot of balls in those last 3 to 6 months.
Confidential,
Absolutely,
the market and things like that. Absolutely, yeah.
That's a big. So the truth is, the wider it's usually quite late in the game. But if you've got the culture right and the thing, they do see it as a positive.
Yeah.
But you don't want them to worry for 3 months and 6 months. That's your job, worrying for 3 or 6 months. It's happened. Let's see what's going to happen next, rather than 6 months worrying about it. Oh, it wasn't as bad as I thought.
And if you've got that culture, I think to the last sale that I was involved in, we knew why they wanted to leave the business. And it was for a positive reason, and so being able to help them to achieve that thing was actually really good, being part of that process. Not everybody is leaving for a positive reason. You've seen some crisis companies, but where it can be something that, people want to be a part of. They want to help you to achieve whatever's next in your life. They want to help you to see your grandkids or your children or whatever it is. I'm in for that. I like it.
Can we just pick up on the different types of exit that are available for business owners for a couple of minutes? Private equity. There's many different private equity firms out there. What is the pros and cons of a business owner bringing a PE organisation into their organisation?
That must be podcast 12, because that's a very long answer. The short answer is, you're right. Even within, so there's private equity, there's family offices, there's high net worth individuals, there's what they call search funds. There's a whole range of what I'll call external investors who aren't particularly hands-on. They're not a complementary or competitor trade buyer. But in that private equity, there's some longer term, there's some short term. They have a fund window that they've got to turn it into cash. That's when you become a little bit more shortism. Some are looking at smaller business. Some you are what they call a buy and build. So you're going into something that already exists. Some is a big percentage of, there's an enormous variety, but the thing that probably brings them all together is they're not usually hands-on. They're looking to have, again, we're back to people and culture. They wanted to back somebody, which is why for a lot of private equity, they'll buy a stake, often a majority stake, but there'll be the earn out exit, the next stage. It's like 2 bites of the cherry. And they hope that they'll bring some value. And so you'll get more for the second stake, percentage-wise, than you got for the first. But that's the private equity side. So really...
And if we don't do a podcast on private equity, people can reach out to you and you can share your experience with
that. Absolutely.
But just staying on the PE theme then for a moment, here's a thought. How does the business owner who has been the one driving the bus They then engage with a private equity firm and they have a difficult couple of months. In your experience, how does that business owner react to having to have some difficult conversations with someone who's been hands-off in the business?
The good private equity businesses, which most are investors, they spend a lot of time. They bring in consultants for the HR analysis before the deal. They're trying to. They want it to succeed. There's a common goal. It's just the cultures might clash a little bit, and it's how they bring it beforehand to bring that culture together of what and being transparent. I think that's the key. But even when they do that, there's one top dog, and the top dog, the owner, has often sold a majority. So the truth is that owner still may be in charge of running the business, but often they've brought a non-executive chairman, sometimes a finance person in their own, if you like, their own monitors. And so there's a challenge. And I think the big area of not even conflict, but discussions, and is when it's suddenly a collective decision, whereas the owner could say, we're doing this. That stops.
Okay.
It's a board decision, a true board decision rather than an owner decision. That's the big. Now they do solve it out because they have to solve it because they've got common interest.
Yeah. You've also mentioned the investment there before the sale, before the agreement. There's quite a lot of time and energy and money often that goes into the due diligence side and the initial conversations.
A PE organisation will ask the owner a number of questions. What questions should be the business leader asking the PE house?
I think the
question
the owners should be, what exactly is the role? We're back to documenting. Suddenly we said about how an owner explains the culture and the objectives to a colleague. Well, they say, tell me what the role is. Explain my job in as much detail as you want. And that's that, one-to-one of what they do, where it's a joint decision, where it's an individual. Things like how much capital expenditure can I spend before there's a board decision, or a PE decision of what do we do for acquisitions? It's working. It's a long list to go through because what you're trying to do is scenario plan.
Yeah.
And to be fair, what if? Yeah. Absolutely. And the private equity do this all the time.
Yeah.
They're really good at scenarios. These are what you need to do. It's why the sale and purchase agreement tends to be really long because they're laying out everything. But that's not a bad thing. At the time, owners think, all this paperwork. I used to be able to make a decision straight away. Yes, but you made the decision. Now it's a collective decision. Let's at least have some rules of the game.
Yeah.
How we're going to make those decisions. Yeah. That's the key.
It also very much depends on the deal structure. So there are private equity companies that will be happy to take a 20% stake. So an injection of cash, and that could be so that the founder can realise some value from the business. It could be to support growth, could be for a number of reasons. But the other end of the scale are private equity businesses that will allow the founder to step away on day one. So what you ask of that private equity company very much depends on what you want to get from that transaction.
Look, be clear on what you
want. Be really clear. Yeah, which just coming back to one of your earlier questions, Liam, the types of transaction. I'd always encourage anybody who's thinking about a sale to break down the elements of what they think they're going to get from it. Is it more time with the family? Is it less responsibility? Is it cash in the bank? Is it all of the above? Is it one of the above? Because we talked a lot about succession today. If a business is going to be here in 50 years' time, well, succession is going to be dealt with anyway, regardless of who owns the business. If it's cash in the bank that the owner wants, you very often see some really strong balance sheets. Business carrying substantial amounts of cash or asset value that can be realised through various different debt structures. Because one of the calculations that we did and continue to do is what could we realise in cash terms from the business if we retained the organisation for 5 years, 10 years, 15 years, 20 years. And once you get past 5 years, you so long as that business succeeds and with a reasonable dividend policy in place, you'll be better off personally in cash terms hanging on to that business than selling it. I'm sorry, I'm taking away from
No, that's fine.
But
Sorry, Ben. That's a really one of the things we do at the very beginning. We say, and we don't do financial advice. We're not FCA regulated at all, but we know people who do that. Say, let me just say this: speak to that person and figure out what you will need in the future, because that's the key decision. And we're pretty frank. If you're 30 years old and you're going to get £1 million, whoa, I've won the lottery. Let me tell you, if you're going to look at 80 years old and inflation at 10% in the last few years, you're going to be back at work by the time you're 40.
Yeah.
If you're lucky, it might be earlier. Or unlucky, sorry. If you're 78 and the average expectancy is 82 or whatever it is in the UK, you're getting £1 million. Don't worry about it.
Yeah.
It's personal circuit, and we are really, we not walk away. We let businesses stay because it's not going to give you what you want. You will be back at work in 5-10 years' time because you've spent all your money. Think about that.
And perhaps, and we've not talked about that today, the void that's left for a founder post sale. Hi, I'm Ben from Horizon. Today, I'm Ben.
Now you're just Ben.
But it's real. You feel it. We were talking about it earlier. It's I think there've been books or papers written on it. Sellers regret. Now I'm not saying I regret the way that we've done it, but I've been on an emotional journey since selling the business because it's such a huge part of who you are. Yeah, exactly.
What's your meaning post business?
Yeah.
Exactly. Yeah. Your vision is the company's vision. It's part of you. So to not have that in your life anymore, and to do it for 5 years worth of cash. Yeah. When I'm not stopping working, so it's.
And that's where we do talk a lot in the alternative board of the difference between company vision and personal vision. Now that you've got this, what does it mean to you? That's a real focus on what's going to be your purpose post business ownership. But I guess you're right. If we don't play golf, if we're not great gardeners, what are we going to do to fill that void? We talked a little bit there about PE. EOTs become very popular over the past few years. Let's give the listeners a little bit of an overview of the pros and cons of EOTs, and with a particular focus on the people. Suddenly now I've got a little bit of ownership in this business. I've got a vested interest. What's happening with the old EOT world?
Well, first of all, an EOT is really just a form of a management buyout. The management, the team, the senior leadership team are owning the business. The EOT was something that was government introduced to give a tax allowance to allow them to not avoid the capital gain and tax on it. It's to defer it to the next owners, so the liability is still there, and you have to have a trust set up, and you've got employee ownership thing. So it's a more complex form of a management buyout, which is frankly government tax driven. To encourage ownership. To the John Lewis model, the co-op models, etc. But there's a big debate at the moment. Is that the best use? Instead of allowing an owner to benefit from a tax advantage at the end, would they be better? In fact, I think it was in the Financial Times recently, and The Economist, would be better supporting owners at the beginning, using that money instead of subsidising by deferring the tax, put it to the front and help businesses grow. Of growth funds. That's the fun. So there isn't a fundamental difference in the sense it's owners running the business. It's succession internally. It's more tax driven, and there is some big advantages to an owner to do that. But there is a little bit more complexity. It's the trust that's paying out the things. So it brings some complexity to the new owners. For the exiter, the person selling the business, it's the same principle, just more tax efficient. That's the fundamental difference.
Yeah, the tax efficiency is the head turner. There's no question. But actually, when you start to get closer to that structure, you realise some fundamentals. You're not going to take your business to market, so you don't actually find out its true value. If you create a Dutch auction for your business, who knows what value you could have attained? You give your numbers to a firm of accountants. They come back and tell you what they think your business is worth. For us, we discounted that down further, because if you're going to continue to lead the business, the last thing you want is the people you've sold it to thinking that they've been ripped off. So we discounted our valuation down further. So we eroded, by not going to market in that discount, we eroded the tax advantages. For us, we provide safe means of working at height. We hire out exactly the same machines that our competitors hire out. And so what sets us apart from those we compete against is how we deliver that product, the reliability of that product, the expertise we're offering around the safe use of that product. That's all people related. We go back to culture. You know, if those people delivering that exemplar service are not feeling great about the environment they're working in, then the service ain't going to be good enough. So one of the attractions of the EOT for us was A, it allowed us to stay in the business, and B, we felt confident we could retain the great culture that we had. So our strategy through the transition, all around the communications that we wrote and planned to deliver, was let's not cock things up, let's not cock up the strategy. And I think we did a pretty good job of that, thanks to some great advice we had from people who'd already been through the process. But there are other downsides. You know, yes, there are banks that will lend money against EOT transactions, hefty interest rates from the analysis we did. Typically, the founders fund the deal, so there's a vendor loan put in place, and the money's paid out over an extended period of time from the profits generated within the organisation. So for anybody who's thinking about selling their business and thinking, I just want out. I'm sick of the industry. I want to sell up and live abroad. Unless succession again, unless they've got that absolutely nailed, then you're likely to be linked to the business for a number of years. For us, that's absolutely fine. We love the business. But for many, that might not work. And so yeah, there are a number of serious considerations that one needs to make if you're going to pursue the EOT route, and again, succession needs to be properly sorted.
Okay, so I've just promoted myself. I've gone from employee now, and I'm now on the leadership team. I'm now on the leadership team, and my owner has confided in me and my colleagues to say that there is this plan in place. What do I need to do as a leader of a business to become that star striker within that business? What do I need to do as a leader? Answers on a postcard.
I just felt all the eyes on me then.
I think something that we encourage, we're just doing 2 management buyouts at the moment. What we try to encourage is there is always a danger of being, if you like, the seller and the buyer mentality. And so you can pay a fortune to advisors, and there are lawyers, accountants, or advisors say, this is what you should buy, this is what we should sell at, and we get this with the advisors. What we nearly always try to do, and so most people do this, is we bring you, Liam, as the leadership team, or part of the leadership team, and the owners, and you sit round that table. Yeah. Write on a piece of paper. Okay, we're back to write. What do you want as a seller? What do you want as a buyer? And frankly, valuation's a big issue. Instead of having 2 valuations and falling them over, there's enough market data to say this is what a business of yours could go. There's a range. And let's start, we call it a valuation framework mechanism. We design that and say, this is what the starting point is. Let's have a talk about it. And what are the issues? And we try to get you, Liam, as the buyer, Ben in this case as the seller, just sit down and let's get the list. Instead of having the advisors tell you, you guys know the business better, get the list and then we'll comment on it. And that builds trust because you're always round the table. And the 2 that we're doing at the moment, I don't think we've had any meetings that haven't had both parties there. So they know everything.
Yeah, there's no secrecy.
There's no secrets.
I think for me, that is the trust thing comes back again and again and again. And it's great advice if you're both within the business and a management buyout or an EOT, whatever that is. But if you're selling or the plan is to exit not with somebody from inside the business, there's uncertainty. So for me, it's about managing change and feeling comfortable with change and open communication. how do you want your role to develop while we build the exit? How do you, like, it's a bit of coaching that person. Like, what will it mean when, I've left? How will your role change? How do you want it to change? Not just about your owner will be gone, but what will that mean for you? And there's opportunity in that, and being able to, feel secure that you can say, I don't want to do that. And we can exit you, actually. It might be an option. I got to know that early on, because I don't want you to leave as soon as I've said I'm selling, because it's going to erode my deal.
And Rena, that's what we say when we're sitting around the table. We're trying to get a win-win.
Yeah.
A lose-lose is there's no deal.
And you want them to be secure as well.
Exactly. But what you don't want is a win-lose, which sometimes happens with two sets of advisors, is, I'm getting a cheaper price. It just creates that win-lose or lose-win. Either way, it's a loss.
Yeah.
Because there's post-deal, there's that little bit of mistrust, skepticism, whatever it may be. And as Ben points out, a vendor, the seller, doesn't get out on day one. And if you think, oh, Ben chipped me on that price, he drove it too hard, the first thing that the buyer's thinking is, I'll get that money back. And so there's friction. You don't want that. And round the table, having all the issues on, and you've been in the business long enough, Liam, that you're buying. Ben's been in it because he set it up. You know everything. And it actually keeps the fees down. Talking me out of revenue is that because you know the business better than we do. Mm. And we're just saying, have you forgot about that? No, we've talked about that. It works. It's something I'm quite, as you probably gather, it's something I'm really passionate about, because I've now seen it over the last few years. It works so well, rather than, here's my advisors, we'd like to buy your business. Or, we're going to sell it, get your advisors. Because
speak to my
then it's like a competition.
Yeah.
You don't want that competition, really. You want consultation and agreement, the win-win.
Just coming at that question from a slightly different perspective, though, let's assume that you're stepping up to lead that business. You're not buying it. You're going to be employed MD. I don't think any founder should underestimate just how long the shadow is that they cast. And therefore, just how potentially steep and long the development curve could be for you to successfully transition into the leader of that business and see the founder properly exit. And I think that, writing stuff down, you're to sit down with you and use every assessment tool available, personality profile, general intelligence assessments, 360 feedback, your own view of yourself, your own view of the role, the job spec you're moving into and working towards, and importantly, tease out the gaps. And this is where you turn to somebody like yourself, Rena, and say, right, help us with these gaps, because there will be some. Some might be showstoppers, actually, and if so, stop the show. Don't progress. But if you can get to those gaps with training, development, whether it's mentoring, coaching, then put a timeline in place, put some proper resource around that, be patient, let the individual develop in their own time. But don't underestimate just what that journey looks like. And I'm speaking from experience there. I would definitely do that differently next time round.
Well, the last 50 minutes has certainly been a win-win for the listeners. So thank you all. Just before we finish off, last couple of questions for you each. Give us one piece of advice that you would give to a business leader who is considering exit, or indeed, if we wish, wants to tweak their culture.
Think of it as an insurance policy. You never know, unfortunately, you're in partnership and your partner dies, it's a family issue that occurs, you get an illness yourself, your personal situations change, all those things. Have the insurance policy, that's there. And at the risk of promoting a book that I didn't write, Professor Christian Stadler has got a book called Open Strategy. It talks about how you build that open culture and get everybody's input. Yeah. And that's what you're on about, the planning.
Someone preparing for exit, someone who wants to improve the culture of the business? Piece of advice, Ben.
Commit more time at the core face of the business to A, get to know your people, and B, talk about the longer term vision.
Okay, right. What if they're not? Yeah, it's both of those for me. It's think about your people more as, how they can help you, how they can be developed, and make it more fun for them to want to come along on that journey. They need to buy into where the business is now, but you want them to buy into where the business is in 5 or 10 years. Yeah, develop. Yeah.
Thank you all. Time has flown by. Thank you very much for your input into today. I really enjoyed it. If you've enjoyed today, please search us on Spotify. Please search us on YouTube, the Alternative Board UK. Search on Spotify for TABcast. You'll see some wonderful episodes. Simon, Ben, Rena, many thanks for your input into today. And if you do want to speak to these guys, I'm sure they'll tell you where you can find them. Once again, from myself and Simon, thank you very much for joining us today. Liam Prendergast, the Alternative Board Wakefield. You can find us on LinkedIn or at www.thealternativeboard.co.uk. Please have a little look at Eventbrite in 2026. We will be running plenty of events around culture, alignment and planning for exit. Liam Prendergast, the Alternative Board Wakefield.
If you want to learn more about taking your leadership team to the next level, whether you're planning an exit soon or not, check out Rena Crossley on LinkedIn or getelevated.uk.
Hi, my name's Ben Hirst. If you would like to chat through anything we've talked about on this podcast today in more detail, I will be delighted to hear from you. You can find me on LinkedIn by searching Ben Hirst. I'm based in Wakefield.
Hi, my name's Dr. Simon Brayshaw. Makes me easy to find on LinkedIn as Dr. Simon Brayshaw. If you want to know anything about how to plan for an exit, whatever that exit may be, please give me a call, or you can find me on our website, which is www.dexteritypartners.co.uk.